One of the critical questions in accounting for acquisitions is determining whether the acquiree constitutes a business or not. This distinction has significant implications for financial reporting. So to simplify this process, IFRS 3 has provided us the optional concentration test. Welcome back to Accounting Zero to Hero. Here we try to make complex accounting standards simple and practical for you. If you're new here, don't forget to subscribe so you never miss out on any new videos, whether it's for your ACCA exams, for your CPA, or for your daily work. Let's start. Today we are diving into IFRS 3, which deals with business combinations. Specifically, we're focusing on the optional concentration test, which is a practical tool to determine if a transaction involves a business or just a collection of assets. This decision impacts how you account for the transaction, so it is important to know how this is performed because it can potentially save you so much time. The concentration test is particularly useful in industries like the real estate investment industry, where, for example, companies often acquire properties held within legal entities. In these transactions, the real estate asset is typically owned by a legal entity. Here we have the acquiree, which might also hold small amounts of cash and rent receivables, for example, like this. This represents a whole company that has cash, receivables, it has liabilities, so it has its own legal personality. So what happens is that rather than transferring the legal title of the property, which can be costly and time-consuming, it's often more efficient to transfer ownership of the entity's shares. So by applying the concentration test, these companies can determine if the transaction is an asset acquisition rather than a business combination. Because the asset acquisition reflects more the substance of the transaction, because basically in these types of transactions, they just wanted to buy the asset itself, this building. It just so happens that there is a corporate wrapper around it, so it is housed within a legal entity. So every time we have an acquisition, we have to ask the question of whether the acquiree is a business or not. So the term business is not following a dictionary definition because it is specifically defined under IFRS 3. What is a business? In accounting, it is possible that you acquired a company with business registrations, it is registered with VAT, it files income tax returns, but it is not a business under the strict definitions of the standard. So basically, what is the standard saying? Under IFRS 3, a business is an integrated set of activities and assets that includes inputs, substantive processes, and both of these are capable of producing outputs such as goods, services, or economic benefits. So this distinction is very crucial in determining whether the company that you are acquiring is a business or not, because basically, if it's a business, we apply the business combination rules. If it's not a business, we apply the asset acquisition rules. We will not discuss the first half here in the left about the business combination rules, but we will discuss how to get around this elaborate business assessment through the optional concentration test. So being an optional part of the process, how is the concentration test applied? That is a very good question. Here, we will show you a very quick flowchart of the decision-making process. This process here will ultimately determine the accounting methods that you will use in accounting for the acquisition, so this is very important. So basically, whenever we have an acquisition, a parent company acquires a subsidiary, let's call it a subsidiary. Whenever we have an acquisition, we need to determine first and understand what exactly are we acquiring, what is in the balance sheet of the acquiree, the company that we are acquiring. Once we have an understanding of what is inside the balance sheet of the acquiree and how much we are paying for it, now we have to ask the question, do we perform the concentration test? This question is very important because the concentration test is optional. You don't really have to perform it if you don't want to. So we have two options here. We perform it, yes, or we don't perform it. So first we go to the left. If we don't perform it, we go straight to IFRS 3, the business assessment. So we have to determine whether the company that we acquired has inputs, has processes, and together they can produce outputs. And it has a little bit more requirements than that. So that's why we're trying to get around this requirement, because there's a lot, you have to justify all of these three that they are present within the company that you're acquiring. So at the end process of that business assessment, you will be able to conclude whether that company that you acquired is a business or if it's not a business. If it's a business, you apply the business combination rules. If it's not a business, we apply the asset acquisition rules. It means that it is an exception to IFRS 3. So what happens then if we say that, okay, I want to perform the concentration test? We answer yes. There are two scenarios that you have. You either pass it or you fail it. If you pass the concentration test, you go straight to the asset acquisition rules. It is that easy. You don't have to perform the business assessment under IFRS 3. However, if you fail the concentration test, notice that it doesn't go straight to business combination, because once you fail it, it means that you have to perform more elaborate assessments to determine whether the company that you acquired is a business or not. So it doesn't go straight to business combination. So if it fails, go to business assessment, and then from then you can still assess whether the company that you acquired is a business or if it's not a business, whether you apply business combination or you apply asset acquisition. I hope that it's clear. We do this assessment for each acquisition or event. This does not become an accounting policy. So for each transaction that you have to perform this flowchart. The optional concentration test is like a gatekeeper. If the test shows that the transaction doesn't involve a business, here you skip the detailed business definition test and move straight to the accounting for it as an asset acquisition. Now let's get into more details. According to IFRS 3, the acquiree passes the concentration test. Remember, we have two options. We have two results. Either we pass it or we fail it. IFRS 3 says that the acquiree passes the concentration test if substantially all of the gross assets acquired is concentrated in a single identifiable asset or group of similar identifiable assets. So basically, this definition has three key components. Number one, what is the meaning of substantially all? Number two, how do we compute the gross assets? And number three, what constitutes a single identifiable asset or group of similar identifiable assets? So we will be discussing them one by one so that you know how to apply the requirements of the standard. So first we have the meaning of substantially all. So while IFRS doesn't define substantially all, it is generally interpreted to be 90% or more. So if 90% or more of the gross assets are concentrated in one type of asset or a group of similar identifiable assets, the transaction is not a business, because there is a concentration of the fair value into one type of asset. So it means that even though it is a business, you have essentially acquired 90% or more an asset rather than, a business that has inputs, processes, and outputs. For instance, if you acquire 10 million worth of assets, so the fair value of the assets is equal to 10 million and you paid exactly that amount. And 9.5 million or 95% of the amount that you paid is attributable to a single building. The concentration test is passed or it is met. And it means that this transaction is not a business combination. So that is all about what substantially all means. Again, I have to specify that the term substantially all was prescribed by the standard, but they didn't actually define how much of the total percentage of the assets is substantially all. However, in practice, you see that we're using 90% or more of the gross assets. So now we go to what is the meaning of gross assets. First, let me read to you what the application guidance is saying about gross assets, and then we will discuss its practical implications. We will have actually examples in this video. So right now, we're talking about the fair value of the assets that you acquired. So not all of that is part of the gross asset where you multiply the 90%, right? The gross assets that you acquired at the fair value excludes cash and cash equivalents, excludes deferred tax assets, and excludes goodwill resulting from the effects of deferred tax liabilities. So it might be a bit, the first two are very easy. The last one, we have to explain it further. Because basically, the gross assets acquired includes goodwill, which we will discuss in the next bullet point. However, that goodwill computation is not the same as the regular goodwill computation because you have to remove the effects of the deferred tax liabilities in the computation of the goodwill. So the next paragraph of this requirement says that the gross assets acquired shall include any consideration transferred plus the fair value of any NCI and the fair value of any previously held interest in excess of the fair value of net identifiable asset acquired. So these lines here, these are exactly the computation of goodwill that we have. So this consideration transferred is the purchase price less the fair value of the net identifiable assets acquired. However, you will see that in the previous paragraph, it says that although there is a goodwill, in the gross assets, it includes goodwill, you have to exclude the impact of deferred tax liabilities in that goodwill, meaning in this excess of fair value of net identifiable asset acquired, you have to have the net equity, assets minus liabilities, and in the liability portion, you remove the deferred tax liabilities. Okay, so let's see the application of those two paragraphs. So it means that the components of gross assets include all identifiable assets acquired at fair value. So whatever is in the balance sheet, you add them up. And then you add the initial goodwill because the goodwill normally is not in the balance sheet recorded. So you have to compute it separately, right? So however, you have to exclude the impact of the deferred tax liability in computing its goodwill. So since all the identifiable assets acquired at fair value, it includes cash and cash equivalents in deferred tax assets, so you just have to remove them. So that the total of that is the gross assets acquired for the concentration test, and this is where we apply the 90% threshold. So if the 90% of that, if this gross asset is concentrated to a single asset or to a group of similar assets, then the concentration test is passed. It also means that we have to apply asset acquisition accounting. So this initial goodwill here is prescribed specifically for the concentration test by IFRS 3. So according to the second paragraph that I showed you, so the initial goodwill is computed as consideration transferred, yes, add fair value of NCI, add the fair value of previously held interest. So these three is the total consideration of the transaction, of the acquisition, less the fair value of identifiable net assets acquired, excluding deferred tax liabilities. So here, this is the excess to be included as gross asset. So you see here, I mentioned it as an excess. The standard isn't actually saying that it's goodwill. They're actually referring to it as an excess. However, for me, I would like to refer to it as an initial goodwill because basically it's a goodwill calculation, but excluding the deferred tax liability impact. So let's see a specific example. The example that I will show you is specifically taken from the illustrative examples of IFRS 3, but I modified it a bit to include the impacts of the deferred tax asset. So let's first read through the illustrative example. An entity, we call it the purchaser, holds a 20% interest in another entity, which is entity A. At the subsequent date, the acquisition date, purchaser acquires a further 50% interest in entity A and obtains control of it. So basically before, there is a significant influence coming from the 20%, and then now we acquired additional 50%, so we now have control. So this is what we call as a step acquisition. Entity A's assets and liabilities on the acquisition date are the following at the acquisition date fair value. So these are already at fair values. So there's a building, $500. There's identifiable intangible asset, $400. There are deferred tax assets, $50. Cash and cash equivalents, we have 100. Financial liabilities, 700. And separate from the financial liability, we have deferred tax liabilities at 160. So how much were the consideration from all these transactions? So the purchaser pays $200 for the additional 50% in interest in entity A. So the consideration of the additional 50% is $200. The purchaser determines that at the acquisition date, the fair value of entity A is 400. So the whole equity, the whole entity A, the fair value is 400. So from here, we should be able to compute the fair value of the non-controlling interest and the fair value of the original 20%. So because of that, the non-controlling interest has a fair value of 120 because our NCI is 30%. We hold a total of 70, so the NCI is 30%. 30% times 400 is 120, and the fair value of the previously held interest is 80, which is 20% of the 400 fair value of entity. So the first step really that you have to do, for me at least, is to compute the excess or the initial goodwill, because we already have the other components of the gross assets. Only the goodwill is not available currently at the moment. So according to the steps that we have already discussed, the goodwill is composed of the following. Number one, consideration transferred, 200 here. The fair value of the NCI of 120 here. The fair value of the previously held interest of 8. So the total consideration of the whole transaction is 400. We have to deduct from this 400 the fair value of the net identifiable assets and liabilities, excluding deferred tax liabilities. So we have a total of 350, which is composed of the 500 from the building, 400 from the intangible asset. We have to add the deferred tax asset. We have to add the cash and cash equivalents. And from all of those total assets, we have to remove only the financial liabilities. So you have to notice that we still added the deferred tax asset because the definition of the standard of this excess only excludes the impact of the deferred tax liabilities in the goodwill. So the excess or the initial goodwill would be 50, which is 400 minus 350. So this 50 is the amount that we will include in the gross assets of the acquisition. How do we actually compute the gross assets? So we have the building plus identifiable intangible asset plus the excess. So the total gross asset would be 950. So remember, we have to exclude deferred tax asset. We have to exclude cash and cash equivalents. So that's why I crossed them out here. And the financial liabilities and deferred tax liability, these are not assets, so these are already excluded from the computation of the gross assets. You will also see that the standard has given us some alternative computations from the one that I have already provided here with you. One alternative computation is to start with the consideration of 400. So basically, that consideration includes already the goodwill and then the total assets, that the total net assets of the acquiree, because that is the in the purchase price allocation, the total consideration is composed of the excess of the goodwill plus the net assets at fair value. So here we can start with the total consideration of 400. Since in this total consideration, we already assumed that the financial liabilities has been deducted, we add it back. And then from here, 700 plus 400, this is already the total assets of the company, which includes cash and cash equivalents and includes deferred tax assets. So here we remove those two. So we will come up with the exact same amount of gross assets. However, for me, basically, I like more the first computation, because you actually see what are the components of the gross assets, which is composed of the building, the intangible asset, and then the excess. And then the excess specifically excludes the impact of the deferred tax liabilities in the computation. So that was the gross asset discussion. Now we will go on with the third and the last criteria that we have in the definition of how to pass the concentration test. What are similar assets what constitutes a group of similar assets? So basically, the standard provides the following guidelines. A single identifiable asset shall include any asset or group of assets that would be recognized and measured as a single identifiable asset in a business combination. If a tangible asset is attached to and cannot be physically removed, and used separately from another tangible asset. So these are all tangible assets without incurring significant cost or significant diminution in utility or fair value to either of the assets. For example, land and buildings, they are attached to each other. Those assets shall be considered a single identifiable asset. And when assessing whether assets are similar, the entity shall consider the nature of each single identifiable asset and the risk characteristics of the asset. So those are the definitions of what are similar identifiable assets. However, the standard also gave us some examples of what are assets that shouldn't be considered as similar. So first one, we have a tangible and an intangible asset. So you cannot consider similar assets if one is tangible, the other one is an intangible asset. For example, a factory building and the patents used in production, they are not the same assets, or they are not considered as similar assets for the purpose of the concentration test. Number two, tangible assets in different classes. For example, inventory, manufacturing equipment, automobiles or vehicles, they're different assets of different classes, because one is a movable property, one is immovable property, the other one is an inventory that's being sold or held for sale in the ordinary course of business. So we also have identifiable intangible asset in different classes. So if there are different types of intangible assets, they cannot really be grouped together as similar assets. A financial asset and a non-financial asset. Financial assets in different classes. For example, if it's an account receivable and then there's another investment in equity securities, you cannot consider them as similar assets. And lastly, identifiable assets that are within the same class of asset but have significantly different risk characteristics. So for this last one, there are actually a lot of examples in the illustrative examples of IFRS 3, but we will not be discussing them further here because it involves deeper analysis on the risk characteristics. For example, if you have acquired a set of loans, there are different types of loans and different types of customers, so you have to assess them properly, whether they have the same risk characteristics, or so that even though they are the same loan receivables, are they really similar assets for purposes of the concentration test. So going back to our initial assessment that we did before with the computation of the gross asset, how do we now check, as a summary, whether the example before passed or failed the concentration test? So all of this are just in the same slide as what we had before, but then we determined here that the building and the identifiable intangible asset, they cannot be considered as the same asset for the purpose of the concentration test. So we have to treat them separately. So now we see that 53%, only 53% of the gross assets is concentrated on the building and 42% is on the intangible asset. So here we can say that the concentration test has been failed. So in this case, we did the concentration test, yes, for this specific example that we have. However, we failed it. So the next step that we have is to actually do a business assessment under IFRS 3, which we will not go into more details. So we cannot yet conclude whether it's a business or not because it failed the concentration test. So it needs like more elaborate assessments. Well, I guess that's it for this video. I hope you enjoyed. I hope you learned something new. Don't forget to subscribe, like, and share this video with your fellow accounting enthusiasts. See you.